Gold, it's the ultimate store of value. It's been with us for millennia. Kings and queens hoarded it, empires were built on it. And today, you, the home gamer, can own it. This isn't just some shiny rock. No, it's a hedge against chaos. It's a safe haven when the world goes mad. That's why we watch it. That's why we track every tick, every move, every shudder in its price. Knowing where gold is headed isn't just an academic exercise, it's about protecting your wealth. It's about making smart decisions with your hard-earned money. So listen up, because what happens this week could put dollars in your pocket. We're looking at the week of July 28th to August 1st, 2025. The summer trading season is in full swing. Volumes can be thin, which means things can get volatile. Fast. You need a game plan. You need to know the key levels. You need to understand the forces pushing and pulling on this precious metal. Is it going to the moon? Or is it heading for the bargain basement? We're going to break it down. We're going to look at the charts. We're going to use the tools the pros use to get an edge. Because in this market, an edge is everything. It's the difference between buying at the top and getting in at the bottom. Forecasting isn't about having a magic crystal ball. Nobody has one of those. If they did, they wouldn't be telling you about it. It's about doing the homework. It's about looking at the evidence. We analyze what just happened to figure out what's likely to happen next. We study the patterns. We look at momentum. We identify the support and resistance that act like trampolines and ceilings for the price. This isn't gambling, it's strategic thinking. It's about putting the odds in your favor. So, pay close attention. The market is telling us a story, and we're here to translate it for you. My mission is simple. I'm here to help you navigate these choppy waters. Some people want to make things complicated. They use jargon to sound smart. Not me. I want to make you money. It's that simple. We're going to cut through the noise. We're going to focus on what matters. The price action from last week gave us a mountain of clues, and by the time we're done, you'll have a clear, actionable forecast for gold. You'll know the levels to watch. You'll know whether the bulls or the bears have the upper hand. Let's get to it. Last week, from July 21st to the 25th, was a wild ride for gold bugs. It was a classic tug-of-war. The week started with a bang. On Monday, the bulls were in charge, pushing the price up with serious conviction. They tested the high from the previous week, around $2,380 an ounce. It looked like a breakout was imminent. People were getting excited. The chatter was all about a run to 2,400. But then, the market did what it does best. It threw a curveball. The momentum stalled right at that key resistance level. It was a brick wall. By Tuesday and Wednesday, the sellers came out to play. They saw the failure at 2,380 and they pounced. The price started to drift lower. It wasn't a panic, not yet. It was more of a slow, grinding retreat. The optimism from Monday began to fade. The bulls who bought near the top were starting to sweat. This is classic market psychology. Fear and greed are always battling for control. The price action chopped around, unable to make a new high, and that hesitation was a signal. It was a big, flashing yellow light for anyone paying attention. Then came Thursday. That's when the floor gave out. The price broke below the support that had held earlier in the week. We saw a sharp move down to the 2,330 level. This was a significant drop. It erased all of Monday's gains and then some. The bears were feeling smug. The narrative shifted from breakout to breakdown. This is why you never chase a hot stock or commodity. You have to wait for your pitch. The latecomers who bought on Monday's strength were now underwater, and their selling only added fuel to the fire on the way down. The week ended on a slightly better note. On Friday, gold found its footing around that 2,330 mark. It bounced a little, closing the week around 2,340. It was a relief rally, nothing more. The damage had been done. We saw a classic reversal pattern. A strong open, a failure at resistance, a breakdown of support, and a weak close. The net result for the week was a loss. It told us that despite the bullish sentiment that is always simmering under the surface for gold, the sellers currently have control of the tape. They won the battle last week. First up, let's talk Fibonacci. No, it's not a type of pasta, it's a powerful tool. It helps us identify hidden support and resistance levels. Think of it like a roadmap for price. After the big run-up we had in the spring, I drew my Fibonacci retracement levels from the low to the recent high. Last week's action was a textbook example. The price shot up but slammed right into the 23.6% retracement level, which was sitting near that 2,380 resistance. It acted like a ceiling. Then, when the price fell, where did it find support? right near the 38.2% level at 2,330. It's like magic. But it's not, it's math. This tells me these Fibonacci levels are being respected by the big money. Next, we look at the MACD. That stands for Moving Average Convergence Divergence. All you need to know is that it tells us about trend and momentum. And right now the MACD is screaming caution. Last week, we saw a bearish crossover. The MACD line, which is the faster one, crossed below the signal line. Boom! That's a sell signal, plain and simple. It tells you that the upward momentum has faded and the bears are taking the wheel. The histogram, which shows the difference between the two lines, also flipped negative and started getting bigger. This confirms the shift in momentum. The trend for now is down. Finally, we have the stochastic oscillator. This is my go-to indicator for telling me if something is overbought or oversold. It's like a gas gauge for the market. A reading above 80 is overbought. A reading below 20 is oversold. At the start of last week, when gold was pushing up to 2,380, the stochastic was screaming overbought. It was way above 80. That was a huge warning sign that the rally was running on fumes. As the price fell, the stochastic followed suit, crashing down from the overbought zone. As we head into this week, it's now in the middle ground, meaning there's plenty of room for it to fall further before it gets oversold. So, let's put it all together. What are the charts telling us? The Fibonacci levels are acting as a clear roadmap, with resistance at 2,380 and support at 2,330. The MACD has given us a confirmed sell signal, telling us the short-term trend has turned negative. And the stochastic oscillator is no longer overbought, which means the sellers have room to push this thing lower. All three of my trusted indicators are pointing in the same direction. They are signaling weakness. They are telling us to be careful. The bulls had their chance last week and they fumbled the ball on the 1-yard line. Okay, here's the bottom line. This is what you came for. Based on the evidence, my forecast for gold for the week of July 28th to August 1st is bearish. I think the path of least resistance is down. The failure at 2,380 was significant. The bearish MACD crossover is the nail in the coffin for the bulls, at least for now. The sellers are in control. I expect them to try and push the price lower this week. Their first target will be to take out last week's low of 2,330. That's the key level to watch. It's the 38.2% Fibonacci level, and it's a big one. If the bears can successfully break and close below 2,330, look out below. That would open the door for a much deeper correction. The next major support level, according to my Fibonacci chart, is down around the 2,300 psychological level, which corresponds to the 50% retracement. I believe this is a realistic target for the week. I do not see the bulls regaining control unless they can somehow push the price back above that monster resistance at 2,380. Given the current momentum, that seems highly unlikely. The sellers have the momentum, they have the trend. Don't fight the tape. So what's the trade? For me, this is not a time to be a hero and try to catch a falling knife. This is a time for patience. If you're a nimble trader, the short side is the place to be with a stop loss just above last week's breakdown point. If you're a long-term investor, a pullback to the 2,300 area could be the buying opportunity you've been waiting for. You have to be ready to act. Don't just sit there, have your levels picked out in advance, know your entry and your exit. That's how you make money in this game. In conclusion, the outlook for gold this week is tilted to the downside. Last week's price action was a clear rejection of higher prices. Our key indicators, Fibonacci, MACD, and the stochastic oscillator, are all aligned, pointing to further weakness. Watch that 2,330 support level like a hawk. A break there should lead to a test of 2,300. The bull market in gold is not over long term, but for this week the bears are having their picnic. Be smart, be safe, and don't bet against the trend. There will be a time to buy, but this week isn't it. Booyah.